All right, Case-Shiller information came out. It's the last Tuesday of the month. Once again, we got a huge dichotomy in the housing industry. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 30th of March, end of the month. Hope you're doing well. Randy Patrick here, putting the realism back in real estate. So let's get into what we want to talk about, because once again, we see home prices rising by double digits. No surprise here. But first of all, if you're not already a subscriber, if you could smash that subscribe button and help my channel grow, I'd appreciate that. And if you think you're a subscriber, but you're not sure, can you try it anyway? Reason being because I'm losing subscribers at a pretty fast pace here. We won't get into it right now, but I really appreciate if you check your subscription and resubscribe if for whatever miraculous reason you're no longer a subscriber. Okay, thank you very much. Okay, today's video is brought to you by our friends at Foreclosure.com. Go to gethousingdata.com. We talk about distressed properties here on this channel all the time. Foreclosure.com is one of the nation's leading providers of distressed property listings. Go to gethousingdata.com to check it out. They got a 7-day free trial, under $40 per month to have an account. You can check it out at gethousingdata.com. Take a look at what's happening in your location, pre-foreclosures, auctions, tax deeds, the whole bit, all in there. Good stuff to know, especially if you want to purchase better priced property than what's going on right now in our double-digit, we'll say, increases going on year over year. So, of course, what we're going to see in the media now will be home prices see highest gain in nearly 15 years. So, yeah, we see that's happening. So Case-Shiller is out. You're going to see a lot of this going on right now. Let's get right to the Case-Shiller information here. So here we go. So it's the S&P CoreLogic Case-Shiller U.S. National Home Price NSA Index. That's the formal name. It's quite a mouthful. Basically reported an 11.2% annual gain in January, up from 10.4% the previous month. Now, we're at the end of March, and I'm talking about January. It's because Case-Shiller, the way they do their calculations, it takes a bit longer because it's an intense calculations based on sales pairs, etc. So stuff's not available, like, say, for example, from National Association of Realtors the very next month. It's usually a 2-month drag. So we're talking about January numbers here at the end of March. So please keep that in mind. Basically, the big winners are Phoenix, Seattle, and San Diego. Continue to report the highest year-over-year gains among the 20 cities in January, based on their there's a 10-city index, a 20-city index, and an overall national index. The 11.2% is based on the national overall index. But, for example, Phoenix led the way with a 15.8% year-over-year increase, followed by Seattle with 14.3% and San Diego with 14.2%. Pretty intense. So putting a lot of properties out of reach for a lot of people. So do you feel like you want to buy at the top of the market? Maybe not. All right. So the strong price gains that we observed in the last half of 2020 continued into the first month of 2021 in January. So again, the trend of accelerating prices that began in June 2020 has now reached its eighth month, and is also reflected in the 10 and 20 city composite indexes. The market strength is broadly based. All 20 cities rose. All 20 cities gained more in 12 months ended January 2021 than they had gained in the 12 months that ended December 2020. So we're seeing significant improvement. January's performance particularly is impressive for historical context. The national composite's 11.2 gains, the highest record or highest recorded gain since February 2006, just 1 month shy of 15 years ago. So it's kind of like that was sort of the peak time frame with respect to the housing bubble, the previous housing bubble, which became the boom, bust, crash, and crisis. So this is the largest double-digit or largest gain in 15 years. It's unreal here. And how can I put it? January's data remains consistent with the view that COVID-19 has encouraged potential buyers to move from urban apartments to suburban homes. So we're seeing a shift. We're creating metro bubbles. And this demand may represent buyers who accelerated purchases that would have happened anyway over the next several years. So maybe there's an impetus to move things forward faster. Alternatively, there may have been secular change in preferences, leading to a shift in the demand curve for housing. Future data will be required to analyze the question. There you go. So lots happening in the marketplace. We all know some of the reasons. We won't get into it right now, but here's the chart. You can take a look at the annual return. So it looks like, if you take a look at what was happening back in 2006 timeframe, where that's sort of like the first housing bubble, housing crisis we had that peaked up there, and now we're sort of peaking again exponentially with respect to the rise in price appreciation. If you take a look at this chart, this gives you sort of a over the years from late 80s to where we are today, and you can see the middle hump there is the housing bubble in 2006 reaching its peak. Three indices, the national, the 10 city, and the 20 city. You can see it dipped to a low point in 2012, and we are much higher than the previous housing bubble's peak. Now that we are in January, we'll look at January 2021. When we take a look at that, guess what? We are 28% above the peak. So July 2006 was, I guess you could say, the highest level on the national index. And you can see that February 2012 was the lowest level. And here we are 28% from the peak, 76.4% from the trough. So really was quite the up and down as far as the national index is concerned. So that's where we are, guys. And, that is a bubble as far as I'm concerned. We know that wages have been far outpaced by home price appreciation, by HPA. So, all these things we know, we're just playing it out as time goes on. The market's controlled. Interest rates are low. It's to help stimulate, greater buying power, things like that. We all know what's going on. We actually have the summary here of the top 20 or the 20 cities that make the 20 city index. Let's take a look at Atlanta. Was up 9.6%. Boston 12.7%. Charlotte 11%. Cleveland 8.9%. Actually, no, sorry, that was Chicago 11%. Cleveland 8%. Well, I'm reading wrong here. Atlanta 9.6, Boston 12.7, Charlotte 11%, Chicago 8.9, Cleveland 11.7, Dallas 9.2%, Denver 10%, Las Vegas 11%, Los Angeles 8.5%, Miami. You know what? Why am I not reading stuff properly here? Okay, guys. Anyway, I'm missing stuff. I'm trying to do this on the fly too fast. Anyway, Miami looks like 10.4%, Minneapolis 10.7%, New York 11.3%, Phoenix leading the way at 15.8%, Portland at 10.6%, San Diego at 14.2%, Seattle at San Francisco at 9.5%, Seattle at 14.3%, Tampa at 11.9%, Washington at 10.7%. One thing I'd like to note that Detroit's back in here at 11%, and for the longest time, for whatever reason, Detroit numbers were not, available to the study. What they're studying was that the clerk was having issues, recording, things like that. I don't know whether I believe that, to be honest with you. I think there's probably more behind the scenes that we're not able to figure out personally, because they've had it, shut off for almost a year now, and now suddenly Detroit's back up at 11%. So there you go. So this is what's going on in pretty much double digits almost all the way through, or pretty darn close to it. I mean, Chicago's at 8.9, and that's your lowest level right there. Everything else, and again, this is year over year appreciation based on what happened in January of 2020. So that's what we're looking at. So it's if you bought a home in the 2012, the trough, you're doing really well right now. Tempting. Do you stay with it? Do you sell it and cash out? Do you do cash out refi? So who knows? But everything's up, and that's the nature of the marketplace right now. But this is where I talk about the dichotomy of the marketplace here. So the door is shut to millions of American homeowners in need of mortgage relief as pandemic enters year 2. So we know that prices have gone up dramatically. We know that we've seen a shift from urban to suburban and even the exurbs and almost rural area. We know that people want places where they can spread out, where they're not in densely populated locations like apartment complexes or multifamilies and stuff like that, for obvious reasons, right? We know that there's been a change in the way workforces are being housed. Like, in other words, you don't have to go into the city to the office anymore. You can work from home. So there's a need for people that maybe didn't like their home or wanted to expand or change up their pace to buy a home or refurbish it, whatever. So there's a lot of change going on in our marketplace. People leaving the urban centers, exodus for other reasons, whether it's personal, pandemic, personal safety, health, tax, things like that, price points, crime, violence statistics, whatever you want. People are moving out. But so we're seeing that. That's on the one hand. So we're seeing all this gain in price point. The other hand, we have distress. Now, the thing about distress is that it's a pressurized pressure cooker of distress, because the distress does not here yet. The distress is being released a little bit over time, and we're all looking at the forbearances, the foreclosures, and things like that. So every week you're going to hear from Black Knight Financial, and you're going to hear the media talking about, ooh, forbearance numbers dropped, see, there's no problem, blah, blah, blah. All right, well, you know what? That seems to be what the focus is. But when you look at this article here, which just came out today, actually, no, sorry, it came out last week, and I just looked at it today and thought I'd put it in here. It says some 14.5 single-family home loans are privately owned with no federal backing and occupy a gray area when it comes to government programs delaying foreclosure proceedings and granting payment forbearance. So the whole point of this is the fact that this is an exposed level. So we focus on the forbearance numbers and things like that. Why? Because we can get at those numbers, sort of, because it's FHA-based, government-backed loans, whatever. So that's what's being calculated because and discussed. So, and as I said, many times in previous videos, I mean, the numbers are samples and extrapolations, and they're really estimates. We don't know what the true numbers are. I do believe that the sources for these numbers are downplaying what's going on for various reasons. That's what I believe in the housing narrative. All right. So basically, the federal government can offer somebody up to 18 months of forbearance, right? And there's other protections and shields of a foreclosure, a moratorium that extends through the end of June. So basically, that segment of people are sort of protected for the time being. There's no nationwide relief for loans that are not federally backed. And I guess that's a situation. So this is the segment that's not accounted for. It's part of the segment that's going to have problems. And yeah, can lenders, do different things, right? Sure they can. Can they help people up? But they're under no obligation. There's no law. There's no extensions. There's no rules. There's no moratoria that they have to follow. So as I said, these guys are shielded by forbearance and a foreclosure moratorium, which is great for them. But the whole point that I like to make here is the fact that the non-federally backed borrowers are sometimes offered only short-term payment suspensions and relatively unaffordable repayment plans, and in worst cases, they've received no relief and lost their homes mid-pandemic. So here is the deal, is that, forbearance is not forgiveness, it's a pause on making payments. Forbearance means that you can take a pause from making payments. You shouldn't be penalized by additional late charges and things like that. They shouldn't ding your credit. And then once your forbearance period is over, you need to go start making your normal mortgage payments. If you can do that, that difference, so that those months that were missed, according to the FHFA and other government entities, they're going to take those missed payments and put them at the back of your mortgage. So, in theory, if you had a 30-year mortgage and you didn't make payments for a year, now you actually have a 31-year mortgage. Okay, your mortgage will be extended for a year. You'll make up those payments with an extra year on your mortgage. Not a big deal. All right. Now, if you can't make those payments, what happens? Well, guess what? Now you go into a loss mitigation component part of the banks and lenders and servicing companies. Well, if you can't make payments, you're either going to go down the loan modification path, and loan modification still means that they're going to modify your loan to certain terms and conditions that they can live with more than you can live with, but you're still going to have to make payments. If you can't make those payments, they really can't do anything for you, and you're going to fall into the pre-foreclosure bucket, and they're going to go down that pathway. As simple as that. All right. So, so basically, this is what happens with that's the government stuff. Now, the non-government backed mortgages, they can do whatever they want. They can do loan modifications. And I can tell you that many loan modifications just simply do not work because what you can afford isn't going to work for what they want or need to get to make it actually work. So the two parties really can't agree very often. That's number one. And number two, oftentimes and more often than not, if you get into a loan modification, there's a greater chance of the homeowner redefaulting. So you might do it for a few months and you're going to redefault because you can't do it in the end. So that's what typically happens in this marketplace. And when you've got smaller lenders or private-backed mortgages, whatever, things like that, there's less flexibility, and they will take it to foreclosure faster. Now, I can tell you that a lot of non-government lenders aren't really pushing the foreclosure filings as much because they probably figure, hey, it's public relations, we're going to be good guys, we know what's kind of going on here. But that's going to run out soon as economies recover, as states open up, as the vaccine gets deployed to more and more people. We're going to see the lenders are going to go, you know what, there's no need for me to hold off on this. I need to start the process of getting the property back. So we're going to see more of that activity starting in the next little while. So really, so the whole point is, all these COVID relief packages and whatever, like I haven't gone that deep into them, but someone was asking me a question yesterday. It's like, well, they've set aside all this money for landlords and renters and stuff. Well, how do you get that money? Where is that money actually coming to people who need it? Is that money being funneled to the right sources? Is it going to renters, so they can pay their landlords? Is it going to landlords so they can keep the renters in? We don't know. How do you do all that stuff? We don't really know the first thing about how this is actually going to work. Yeah, you can carve out all these dollar value levels in stimulus packages or relief programs, but at the matter, having it sit there is one thing. Being able to access it and get it and put it into play to make a difference is something else here. So that's really what it boils down to. So you're going to see more people going, hey, how do we help homeowners? Now, I can tell you that lenders don't want to foreclose on people. If they can pull something off and they can work with the homeowner, they're going to do it. The homeowner has to ask, though. The lenders don't come and say, hey, they'll send you the required documentation as per the CFPB that they have to do, and say, here, we have all these options for you. But the homeowner has to actually engage and figure it out. So we'll see what happens as time goes on. But this is what I'm saying. We're going to see more and more of these problems start surfacing very, very soon. So that's why I kind of say here we do have two housing markets going on. High appreciation right now. So we're seeing that hey, housing hype hack guys are going, this is great. Housing bubble bros, you guys are smoking it. You don't know what you're doing or talking about. Well, you know what? You can talk about that all day long because the market's controlled and manipulated right now, and it's being propped up. All right. The distress, the forbearance, the foreclosures, that's in the future. The question is, how will they intersect? So are we in a housing bubble? Most economists and smart people are going, we're in a housing bubble, all right? The real question is, how will the up and down markets intersect? How will we crash? What will be, the timing of the crash, the value of the crash, how will it impact us? Well, it's going to be a managed and controlled crash. It's probably going to go location or metro by metro, depending on the demographics. Some locations are losing people and other locations are gaining people. So you can see the losing areas may suffer more, and then the gainers are going to grow for a bit, and then they're going to have some issues as well too. So you got to keep that in mind. And by the way, we don't mention this too often. We still have 3.2 million underwater properties right now across the board. So last time, Adam Data Solutions does their, I guess you say their analysis on a quarterly basis on equity and underwater. Well, the end of fourth quarter 2020. 3.2 million underwater homes. So to me, I'm kind of going, well, where are those 3.2 million homes? Those are 3.2 million people that really can't sell their homes because they're underwater, which is kind of funny. So I'd like to understand a little bit more where those homes are located. I do have some ideas, but the point is they don't have the equity to sell. They'd have to bring money to the table to close, and who's going to do that? If they are affected by the pandemic and job loss and things like that, those could be part of the number that's this nebulous number that could start to shift and being seriously underwater, you may fall quicker into that foreclosure path because maybe right now they're just maintaining their payments potentially, but they can't sell. So they're stuck in their houses, and it's only going to get worse when market prices do shift the other way. All right. Okay. So having said that, when will this ride end? The market can't be sustained. Well, we go back to, Black Knight saying about 3.354 million people in a distress situation, which includes foreclosures, pre-foreclosures, delinquencies, and forbearance numbers. All right. I know it's not an accurate number. We get conflicting statistics. I literally was listened to a webinar earlier this week, and I can tell you that whoever was on that webinar actually contradicted what they said a couple months ago with respect to what they think they're going to see with foreclosed homes or foreclosure opportunities. And it's the same data source, same data companies, as far as I'm concerned. So I had to laugh at that, going, we just create our own narratives as time goes on. That's how we do. We just say to get through. We know that equity is not the answer. Everyone, we don't have situations here. Everybody who has these problems will just sell their home with all that huge equity, and they'll be happy and sell, and problems are avoided. Everybody. Well, we know that you can't rely upon your equity, and the longer you wait, the less equity you have. And then the less equity you have means you got to sell quicker, which means you're going to sell the discount. You're not going to get what you want, which means price points are going down, which means the next person can't list their home as high as yours or go higher because the market won't bear that. So their equity gets nipped as well too. So you see, that's how it all starts. So this will be a change for us in the future. We talk about all the time short sales, other pre-foreclosure sales are poised to become a dominant share of the distressed market in the near future. We know that's going to happen, so get prepared for that. Pre-foreclosure sales set to dominate distressed home market. We can take a look at the statistics and see that it's been growing year over year. The 2020 is an estimate from Adam based on what they think 2020's dispositions are going to be. So obviously, the orangey color is real estate owned REO sales. Well, there's less of those because less going to foreclosure because of less processing of foreclosures. But on the pre-foreclosure sales, that could be short sales and or just people selling while they're in the foreclosure process, cashing out their equity, and if they have any, and just moving on. So that's increasing. So we're going to see more of that. Certain locations, there will be equity that they can dip into, depending on how long they've not been paying their mortgage. And other locations will be no equity because of the way the market works. All right. 1% of all the on-market property sales fall into the distressed property category. As I mentioned, REO sales and short sales. No one's doing short sales. How do we know this? Well, the 1% rule. If I show you the 1% rule, which is what? Real estate Realtor Confidence Index survey. So this is the most recent data from February 2021, supplied by National Association of Realtors. We can see that distressed sales are only 1% of the entire marketplace, which means if we just take it in half are REOs, simplistically, and half are short sales, which means makes no difference to what happens to this little market overall on price points. And therefore, no one's doing the market, which means huge opportunity. That's what I focus on. Foreclosure filings are quietly increasing. More properties becoming scheduled for foreclosure auction. Again, think of that 1% rule I showed you. What's the next opportunity? Well, we're going to expect more distressed properties. Owners will need to sell. The longer they wait to sell, the less equity and money they're going to have. Investors are going to try to liquidate. I can see a lot of ma and pa investors, a lot of people who own maybe rental properties that they're deriving their income from that are getting hurt. Renters aren't paying, etc. They're going to have to liquidate. We will see an uptick in foreclosure auctions. So as things open up, it's the foreclosures that were in process before the pandemic started. Well, they're going to start back up and they'll finish their process. We'll see an uptick in foreclosure filings. So everything that was maybe going to start, or the forbearance situations, it will manifest in foreclosure filings, which hopefully we'll see more short sales listed. Eventually, an increase in REOs, after the foreclosure sales go through. There will be more than predicted. We are not seeing the true numbers, as I say, because I analyze this. I talk to people who are in the know and who get involved with the data, and they're saying, what's being spoken about in their neck of the woods, their areas, is not what they're seeing from a statistic point of view. So again, back to the narrative. I have a new program called Zombie Foreclosure Flip, which basically is distressed property and never pay retail all bundled together. If you want more information, please give me a shout. Example of what's happening here, and I'm going to qualify this like I have. This is my Metro, my MSA, which is the Tampa, St. Petersburg, Clearwater area. Goes to show you that at the bottom that our inventory is less than 1 month's worth of property available listings. What that means is if no new listings came on, it would take, at the pace we're selling, it would take less than a month, 0.09 of a month, to sell all those listings. All right, so that's the situation we're in. So and other MSAs in the states have the exact same issues as well too. When we take a look at price points, this is what happened in January of 2021. I don't have the MSA numbers yet. They're not compiled for the general MSA. I have it from Hillsborough County, but not the general MSA, which I wanted to show. So when I get that, I'll be updating this slide. We can see the median price point for single-family homes, just single families, not vacation, rent, not income villas, townhomes, manufactured mobiles, just SFRs, okay? You can see that the $285K was the median price. REO sales 180K, short sales 194K. So short sales were roughly 0.6% of the overall single-family market in January. That's a 32% discount if you look at the median versus median price there, over 90K in equity differential. So people who say short sales are not good or they don't understand them, they don't want to do them, well, gee, there's your opportunity right now to look at discount and that equity. And I keep saying we probably can do just as well, if not better, because we know how to position properties to get the majority or increase equity positions. I can tell you most of these sales were probably just, well, how can I put it? Like, retail short sales. So they weren't really fighting for us to get a contract, get it closed, whatever. So that's why we'll see differences as time goes on. All right. We want more information. I'll tell you about it. Just connect with me, Randy@luxuryshortsales.com. Send me an email. Tell me your phone number so I can text you. Once again, thanks for the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. And if you are, or you think you're a subscriber, please do me a favor and check that out. Hit the subscribe button again, just because, as I said, my channel is spinning here for various reasons, and it shouldn't be. I haven't been growing for quite some time. I know I'm growing behind the scenes, but from what this platform is telling me, it's not letting me grow or showing me that I am growing. Get what I'm saying? All right, guys, take care. Look forward to speaking with you in a couple of days.